The boredom effect
The
of
boredom
passive.
effect.
Let's talk about
Right.
passive a little bit.
So in a previous podcast, we used the example of 401k plans where you have a very limited choice of what your investment style is, and you tend not to look at it very often because you can't, if you're in your 30s, you're not going to have it for 30 years and that kind of thing, right? You can't have access to it. So you tend not to look at it, be like, oh, I can't have that money for 30 years anyway, so I don't even look at it. That's a really healthy mentality that people have about their 401k plans that they don't necessarily extrapolate and apply to their other portfolios.
The other investing that they're doing, right?
Right. And another great example of that is when parents or people set up 529. I'm just going to stick with parents. Parents set up 529 plans for their kids. And if they set up a 529 plan when they're a year old, they're not going to need or even be able to have, well, okay, I'm going to use college as an example. So they're not going to need to fund the college expenses until their birth year, 18 years old, and call it 21 or 22 years old.
Correct.
Right? The first dollar will be at 18 and the last dollar will be at 22 if they're in 4 or 5 years of college, right? Okay. So when you look at the performance of a 529 plan, which doesn't have you can't just go in and buy NVIDIA in a 529 plan, right? They're super boring. When you wake up 18 years later and your kid's about to go to college, you're like, wow, this thing's returned 10% a year annualized after fees. And you're like, yeah, because you didn't mess with it. It was a passive investment. Nobody's looking for casino-like action in the 529 plans, right? People get drawn to the flashing lights and fresh oxygen in their trading portfolios. And that's where the boredom thing actually becomes a very difficult thing to manage, because if you just took the money and put it in, there's all these charts that say, if you invested $1,000 in the S&P 500 index all the way back, look at what it would be worth now. Pick any period of time, as long as it's greater than 10 years, there's some sort of positive return, right?
Yeah.
So when you look, but that's boring. I mean, who wants to sit around a cocktail party and talk about SPY? Right?
Well, it's when your brain gets in the way
That's
of,
right.
Not your brain, sorry, your heart gets in the way, or in your gut of the brain.
Or FOMO or any of that.
But I think you brought up the perfect point, is because the big ETF out there that a lot of people buy for just broad market exposure is SPY.
Right. And that tracks the performance of the S&P 500 index pretty closely.
Yeah.
And it's low cost.
Low cost. I'm not trying to beat the market. I'm trying to be the market.
Right.
Well, if you look at the returns of that SPY ETF over, to your point, a 10-year period, and you compare it against, let's say, if you look at it up in Morningstar, you'll see that they put different categories. So other large cap blended kind of investment managers, you're in the top 18th percentile.
Right.
Meaning you're better than, to your point again, I think a lot of the world and all those people who are trying to maybe be a little bit more active by just staying invested. But that's not easy.
Right.
That's not easy either, because there's plenty of studies, and we've talked about them in previous episodes, about staying the course is hard because you either get bored, you start chasing shiny things, or you panic.
Yeah.
And really, that's why, again, even if you're doing passive investing, the markets are still going to drive your returns. You can't panic in order to get the successes or maybe the benefits of passive investing. Active managers, and why I think the way we monitor and try and run portfolios, during periods of declines, they're usually trying to limit losses but capture gains, right? Most active strategies have some component of that. How they do that, million ways under the sun.
Right.
So when you think about it, again, you still just have to be invested. Whether you're passive or active, I think, like you said, there's maybe a blend of both.
Yeah.
Because even in the active space, so let's talk about, again, the different types of active management. There's some that are more active than others. How active can you stomach is really, I think, the question that everyone needs to ask.